All right, we're on the last video for chapter 9. So we're looking at dollar value LIFO retail. Okay. When the ending exceeds the beginning, a new LIFO layer is created. Okay. So if you wanted to review, we did that dollar value LIFO, I think in the previous chapter. And now we're going to apply the retail method with this. Okay. So here we go. We have our information. And we have the layers. I think we might have gotten these same numbers, but let's kind of go through them just in case you didn't just watch the previous video. Okay. So our beginning, then we have net purchases, markups, and markdowns. We have including beginning inventory and excluding the beginning inventory. So we have two different numbers here. Okay. So we're going to come down here and we are going to say our price index for 2027 is 1.10. Okay, so let's pull that calculator up and let's let you watch me put it in the calculator. So we have 198 divided by 1.10. Remember, we are trying to get it in those base year dollars. Okay, base year dollars. So we get 180,000. We had 160. How do we know we had 160? Because there it is right there. Okay. 160 from the base layer multiplied times a dollar multiplied times 62% gives us 99,200. Then we needed another 20,000. That's our 2017 layer. Multiply that times 1.10 and then multiply it times 0.6468. Okay. Then we add those two together. That is our ending inventory at the dollar value LIFO retail cost. Okay. So they actually take us through another year on this, which I really like. Okay. So in the next year, they calculated 226, 200, and we're going to divide that by the price index that year of 1.16, gives us 195,000. We had 160 that layer, nothing happened to that layer. We gained this $20,000 layer. Now we have more. So those two equal 180. And then the difference is the 15,000. So 180 minus 195. And they gave us this percentage of 63%. So we didn't calculate that. They actually gave it to us in this problem. Okay. So then multiply all those out, the price index plus the percentage, that's your cost to retail. Okay. This is retail dollars, and that's why we have to use that percentage. We didn't have to do that in what we did in the previous chapter. Okay. So our total ending inventory at the dollar value LIFO is those three numbers added up. Okay. And they go one more year, I believe. Yes, they're not going one more year. They are going to assume that in 2028, which we did a 2028 up here, but in different situation, we're going to assume that the ending retail value was 204,160. Okay, so if you take the 204,160, divide it by the price index, gives us 178. We know our base was 160. That's our $1, 100%. That's our base layer multiplied times 62 gives us the 99,200, and we only have 16,000 from that 2027 layer. Multiply it times 1.10 and that percentage. There is no new layer for 2028. And if you went to 2029, there's no possible way to create a 2028 layer, okay, at all. Okay, so keep that in mind. All right, we are moving right along. Y'all can pause the video and do this one if you would like. Let's talk a little bit about change in inventory method, okay? Most inventory changes are retrospective. Retrospective means going back and restating financial statements just like you had been using that inventory method all along. Okay. When we change to LIFO, though, it is very hard to do that. So we just adopt that in the beginning balance, and then we consider that the base year, and then we move forward. So they call that prospectively. Okay. All right. So here we have AutoGeek Inc., a wholesale distributor of auto parts, began business in 2024. Inventory reported on the 2026 year-end balance sheet determined using average cost method was 123,000. In 2027, the company decided to change its inventory method to FIFO. If the company had used FIFO method, in 2026, inventory would have been 146,000. What steps should we do? So first of all, we are going to make an entry. The difference between those two is 23,000. We are debiting inventory, 23,000, crediting retained earnings. Okay? This is one of those things that, like I've told you many times, there's not a lot that affects retained earnings, but this is one of them. Okay? A change in inventory method. We're going to revise the comparative financial statements to appear as if the newly adopted inventory method, FIFO, had been applied all along. Okay, we're going to disclose that too. Okay, so here they give us some disclosures on them telling about the inventory method. Why did they change to it? Usually, the reason they change is because they're going to have a huge loss because they ate away some of that LIFO layer. That's usually what they do. Okay. Change to LIFO. So when a company changes to LIFO for any other method, it's usually impossible to calculate the income effect on prior years. So to do so, we require assumptions as to when specific LIFO inventory layers were created. Okay. Company charging to LIFO, changing to LIFO, sorry, does not report the change retrospectively. They actually go forward. That is what they say prospectively. Okay. Then the base year inventory is the beginning inventory year for the LIFO method is adopted. Okay. So here they kind of show you nature justification for the change. Under FIFO, revenue costs are not aligned. Under LIFO, the current cost and sales are matched to the current revenue. That is a really fancy word of saying we were going to lose a whole lot of money if we stayed with LIFO, so that's why we switched to FIFO. So, just to be very honest, okay? All right. Why retrospective application was impractical? Because it's really hard to figure that out when you're moving to LIFO. Okay. They tell us the effect of the change. These are all disclosures. Okay. Here's another problem that y'all can work. And now let's talk about inventory errors. I don't like to spend a whole lot of time on inventory errors because if you don't catch an inventory error, it will fix itself in 2 periods, as long as the second period you count the inventory correctly. Okay, so we have an example here. Inventory error correction. Barton Company uses periodic inventory. At the end, a mathematical error caused an $800,000 overstatement of ending inventory. Assume the error in 2026 is discovered in 2027. Okay, we have beginning inventory plus purchases, less ending inventory. We have ending inventories overstated, which understated cost of goods sold. Okay, so understated cost of goods sold. So an understated cost of goods sold means an overstated net income and an overstated net retained earnings. Here is another one of those entries affecting retained earnings. Okay, we're adjusting the retained earnings prior to doing the current year's financial statements. Debit retained earnings, because remember, debit to retained earnings decreases it. And then we're going to credit inventory, which will be decreasing that amount of inventory as well. Okay. All right. I believe they go through here and they're showing you that if they just counted it correctly in the next period, the retained earnings is corrected. Okay. So if they didn't find it till the end of 2027, it's not going to really matter. Okay. Let's talk about earnings quality. Inventory that has to be wrote down because it expired, because it just was obsolete. That is not good quality of earnings. Okay. A financial analyst must carefully consider the effect of any significant asset write downs on the assessment of the company's permanent earnings. Okay. Again, you can stop the video if you want to work on that problem. Okay. And that is it for this chapter. We are done. We are not doing this appendix on purchase commitments. So I will see you in the next chapter.